Welcome back to Invest, Buy, and Sell with Jael, where we highlight some amazing people that are absolutely crushing it in their industry. Today, I'll be facilitating a powerful and eye-opening conversation with a woman who went from 30 plus years in IT, working with Fortune 100 companies, to becoming a real estate investor, private money lender, and life insurance expert who's on a mission to help families build and protect wealth the smart way. We're going to be talking about how she's earning double-digit returns through real estate, why she's so passionate about using life insurance while you're alive, what it really means to be your own bank, and how families can stop relying on GoFundMe and start creating generational wealth instead. She will break down infinite banking in a way that actually makes sense, no fluff, just facts and strategy. Whether you're an investor, a parent, or just tired of watching your money sit, you need to hear this. Please help me welcome Deb Stephenson. Hey,
And the
Deb.
crowd goes wild. Yay.
Woo! You're a rock star. I'm so glad you're able to join me today. Where are you streaming in from?
I'm in Southwest Florida on the West Coast. It's going to be a nice 90 degrees today.
I'm jealous, but I'm not as jealous as I would be if it was winter here.
It's true. That's true. It does get a little warm in the summer.
Yes. Well, Deb, first of all, I just want to thank you for being the person that you are and for helping me learn and educating me on IULs and infinite banking and how powerful it is. Yep. So I just want to start with you just giving us a little bit of background about yourself and then how you got into the financial space to begin with.
Sure. So my background is, like you said, 30 years in IT, working for some major Fortune 100 companies. I semi-retired in early 23 and got into life insurance, strangely enough, by somebody in the real estate investing community who introduced me to something I never heard of called infinite banking. And I was like, what the heck is that? And when she explained it to me, I kind of furrowed my eyebrows a bit. I was like, what? Is this a scam? Because it sounded too good to be true.
Right.
And when she explained it to me, I was like, I think I could really get behind this product because I'd never heard about it before until she told me. And I wish I'd known about it before because I would have done things differently. So I decided I was going to get my life insurance license. And I did that, and I just want to educate everybody to know that there are other options about saving for retirement and being able to get loans without using banks. And nobody ever taught me this stuff. There's a lot of financial, I think, education that should be taught in school that's not. So I'm here to hopefully bridge the gap and tell people that there are other opportunities available than your traditional accounts that everybody uses today.
Absolutely, Deb. I I'm a victim of not knowing, as much financial information as I should. And I know that a lot of people are. So I'm glad that you touched on that. Yep. Could you, in your own words, just explain to us what an index universal life insurance policy is?
Yes. So it's a permanent life insurance policy. So there's two different types of life insurance. There's term, which is much more affordable because it's a term policy. It only lasts for whatever term you buy it for, 10, 20, 30 years. After that, you don't have insurance unless you renew it, and then it gets very expensive. So it's not permanent, but it's very affordable. And it's very affordable because, believe it or not, only less than 1% of those policies pay out because most people outlive the term that they bought the policy for, which is fine because you'd rather have some coverage than nothing if something happens. Permanent life insurance, though, is just that. It lasts your whole life as long as you pay your premiums. But permanent life insurance has a lot of other benefits that go with it because it's more expensive. So it does have living benefits that you can use while you're alive. It accumulates cash value while you're alive. It has, a death benefit that, well, IUL anyway, fluctuates based on what your premiums are and how much you're putting into the account. Your death benefit is going up over time. It's a really great product to have if you can afford to do permanent life insurance because it just is very flexible. You can change your premium amounts. So if you decide initially that you wanted to put in, $300-400 a month, and you fall on hard times, you can lower your premium if you want to. If things change in your life, you can increase your death benefit. You can lower the death benefit. So there's a lot of flexibility with the product, which is what I like. It kind of moves with you as you go through your life.
Yes. And I mean, can we all agree that life changes, circumstances change, and who the heck wants a death benefit that's going to lapse on them? I mean, I want a term
Exactly.
that's going to last with me for the time that I'm living, and as we get older, I know it gets a little bit harder to qualify for these things due to health and all of
Right.
those, different factors.
Yeah, and that's what I try to tell people, buy it while you're young and you're healthy because it's cheaper, obviously, but you might think you don't need it right now because maybe you're 28, you're not married, you don't own a home yet, but someday you probably will. Someday you might have a family. Well, have the insurance in place now while you're young and healthy, and then when you get to those milestones, maybe 5, 7, 8 years later, you've already got it in place, and you don't have to now pay higher rates because you're 8 years older. Maybe
Yeah.
you've got some health conditions. You know what I mean? So it's definitely cheaper, and I think more advantageous to buy it when you're young and healthy so that you can make sure you're insurable.
And I think that was a mindset shift that you helped me with, Deb. I mean, I'm close to 28. I like to say that. I'm not 28, but I'm super excited that I did it when I did. But it was a mindset shift, Deb, because you're
Mm.
like, I'm not going to die anytime soon. And it's like a weird just essence about getting life insurance for people. And it's because you have to plan for death, but we all know we're going to die, so get it.
Exactly, and that's one of the things that's a little frustrating for me is, I talk to a lot of people that don't have life insurance because, like you, I'm a real estate investor. I have been since 2010, and we run in the same circles. And I talk to a lot of real estate investors who are, they're 1099s. They're doing their own fix and flipping. They're doing short-term rentals or whatever, and they don't have life insurance. And their mindset is they don't need it. And well, yeah, maybe not now you don't need it, but you're gonna die. I mean,
Right.
we're all gonna die, right? We're only here for, a short amount of time. And, I try to convey to people like the life insurance isn't for you, obviously. It's for those you leave behind,
Mhm.
typically anyway. So like what's your plan if something happens to you? And one person actually said to me, well, I hope nothing happens to me. And I said, well, that's not a plan. Um,
It's not real.
you know, no, it's not. But you know, life insurance is, it's boring to talk about because most people just think about it as, buying life insurance for the death benefit. But like you said, you can use it while you're alive. If you overfund that policy and build up that cash value, that's your money. So you can go borrow it and do whatever you want with it. The insurance company is not going to ask you what you're going to do with it. They're not even going to make you fill out a form.
That's what we're going
So
to dig deep into, Deb, because
yeah.
people don't understand that part. And that's why this interview and you speaking today is so important, because they need to understand that this is something that you can use to leave a legacy. It sounds like legacy building, what you're talking about. So,
Yeah, I always say, like, leave your family a legacy, not a liability, you know what I
right.
mean? So, I mean, the last thing they need is more stress because, let's face it, if somebody close to you dies, that's a very emotional time, and now you're gonna add stress onto them of like, "Oh my god, how am I gonna pay for
Where's
your
the money coming from?
your burial," and survive.
I think it's
So,
important, Deb, to note that not only can we get insurance for ourselves, our business partners, you mentioned us being in real estate,
yeah.
for our family members that we know aren't going to get insurance, and we still can use that to support them in death, as well as their other family members or whatever you need to do afterwards to take care of that.
Right, and actually, if you have a business partner, life insurance is used to buy out your partner's equity too. So
Ooh,
if you have a partner, just so say you and I are partners together in a business, we're doing fix and flips, we're doing midterm rentals, or we own RV parks, whatever. If you die, I don't want to be in business with your family now because who's my partner going to be if you die? Well, it's going to be whoever you will. Hopefully, you have a will. it says, who's going to get all your things, but like, I wouldn't want to be in business with your family members who don't know anything about real estate. So you can have what's called buy-sell agreements, which is just like you take out a policy on me, I take out a policy on you, and we agree, and there's a contract written that says, hey, if you die, the proceeds, the death benefit amount from my policy is used to buy out my equity. So it goes to my family, which would be your family, and I keep the business to myself. So that way there, I don't end up in, a partnership with your family, and you don't end up in a partnership with mine.
The family that doesn't even know how to do real estate, let's face it.
Exactly. I know, they'd be like, okay, what do we do now?
Right.
Don't
And
worry,
it
here's a
sounds
check.
like proper planning. You know what I mean, Deb? It's like this
Yeah.
probably should be part of a business plan. This probably should be something that we say we have to do to make sure that worst case scenario, everyone is protected. The employees are protected. The assets are protected. So I think that's super important.
Yeah, there's just so many different ways to use life insurance, but everybody, the common thing that everyone thinks about is just the death benefit.
Yeah.
But it is used for so many other things. I mean, you can retain key employees with it. There's key employee insurance. You know what I mean? So that you fund a life insurance policy for them, building up that cash value for them, which gives them incentive to stay, and that policy is theirs. There's just so many different ways to use life insurance.
And I think the education and also the lack of education is what scares people about it. And that's why I really enjoyed working with you, because you gave me the parts that I needed at a time. And every time I talk to you, I learn something more. So Deb, can you tell us why getting a policy is probably better for wealth building than having a 401k or self-directed IRA, which those are great, but can you give us just a little insight on why having an IUL may be better?
I don't know if it's better, but I would say that you should add it to your arsenal of, diversification as far as where you're putting your money. I mean, I think everybody has 401ks that works for, a corporation, because typically they do give you free money. And if your company is offering a match, you should definitely, match up to whatever they're going to contribute for free. It's, free money. But I wouldn't say to put all your money in a 401k, because what happens is you get that little tax break when you put the money in, like we all do, and it seems good at the time, but your 401k is going to grow over decades and decades and decades, right? Because that's what you're using for supplement your retirement. And so it's going to get to be this huge amount. And now you're going to have to pay taxes on this ginormous amount, which is going to be significantly more than what you saved when you put the money in. And but some of the reasons that you might want to, consider putting money into a overfunded cash value life insurance policy is because it has much better tax advantages. So you put the money in, it is after tax money. You can't, take 401k money or IRA money and buy life insurance with it directly. So you put after tax money into the policy, it grows tax free, and then you use it tax free. So Uncle Sam doesn't get a piece of the pie.
Right.
And it's perfectly legal. It's approved by the IRS. So it has tax advantages. It grows, it's safe. You don't have to be exposed to the stock market. And right now, as you can see, we've been pretty volatile in 2025. So you don't have to worry about that. There's a 0% floor on these policies, which you don't get with your 401k or a Roth or anything, because you're in the market.
I was surprised to hear that.
Yeah. Well, like the IUL, like you said, it's indexed universal life, and the index piece means you're mirroring an index in the stock market, such as the S&P 500 or plenty of the other indexes. But you're not directly invested in that index. So that's why you can have that 0% floor. So you only participate in gains. Okay, you never participate in losses. And I think this year the S&P is down over 9%.
Wow.
So you don't ever have to be making up for losses to get back to where you were to start growing again. So in a policy, it looks more like a staircase. So when the market's doing bad, you're staying level. And when the market goes up, you go up. When it goes down, you stay level. When it goes up, you go up. So it's a staircase instead of the up and down you see
Yes.
from the stock market, and the downs are the parts that we don't like, right? So you have that safety. There's liquidity. You don't have to sell something like your mutual funds and whatnot when the market is down to get access to your money. It's your money, so you can take it out. If you have cash value, you can borrow against it and use it for wherever you want. Nobody's going to ask you what you're doing with the money. So it doesn't have the penalties and the restrictions that a traditional IRA or 401k has. Excuse me. Um, there's no age restrictions. You don't have to be 59 and a half to take the money out.
Yeah.
No penalties. So there's a lot of advantages.
And like you said, it's not necessarily better. It's just different. And these are the differences that people
it's
can
an alternative. Yeah. It's an alternative way to save money that a lot of people don't know about, because it's, financial education is just not taught in school, but
it's not, and it should be, Deb. I was kind of like blown
you know,
away, and I'm like, I don't know as much as I should about finances, and I'm in business where a lot of money is going in and out. So why am I not leveraging my finances better? And I love the staircase analogy when you're talking about the IUL, because it gives people perspective to say, oh, I do go down a lot with my 401k when the stock market drops. But with my IUL, I'll just stay level. And then when it goes up, I get to go up again. Everyone likes to go up. Nobody likes to go down.
Exactly. We want to participate in the upside, not the downside, which is what permanent life insurance allows you to do. So, plus it has the living benefits, like you said. So another reason to put money into a policy is if you become chronically ill, critically ill, or terminally ill while you're alive, you can access your death benefit amount and use that money while you're alive to pay for medical, pay your mortgage, your bills, whatever. Because if you're having an illness like that, you're probably not working.
Right.
So, but your bills are still rolling in. Like nobody cares that you're not working. Your bills are still going to come in, so you can access those that death benefit amount while you're alive if you have one of those three conditions. So that's another thing that you won't get in your 401k or your IRA. There's legal protection. So if you're a doctor, and people like to sue doctors, cash value of your life insurance is typically protected from lawsuits and liens and things of that nature, depending on the state. There's just so many advantages. No required minimum distributions like a regular IRA. So no one's going to tell you have to take out money even though you don't need to. There's just a lot of benefits that people aren't aware of.
And Deb, people are going to say, well, this is so great, just like you felt. This is too good to be true. And a lot of things that we love today were too good to be true 50 years ago. But this has been around for a very long time. And I know people are going to say, how do I not know about this? But would it be safe to say that a lot of ultra wealthy, high net worth individuals have been doing this for a very long time? Who are some players in this space, Deb, and what do they use it for?
Yeah, well, I'm not sure if anyone that's watching is familiar with J.D. Rockefeller, the oil tycoon, but he was a famous one for using life insurance to create generational wealth for his family. So they had policies on all the Rockefellers had their own life insurance policies, and when they died, the death benefit would go back into the trust. The trust would pay off any outstanding loans that they had on those policies, and then they would buy more life insurance for the next generation. And so that's how he's created generational wealth. And the trust has very restrictive guidelines as to what the money can be used for, right? So it's only for, I think, charity, business acquisitions, and something else, I forget. So it's not, you can't just take money out and go to the casino.
No,
so he set up this trust to be pretty ironclad, so that generational wealth will continue in his family for generations and not be spent foolishly. So
your
he did
family
that. Walt Disney did something similar. I mean, Walt Disney he used it. Yeah, there's a lot of what do you call it? Not celebrities, but famous people that have used their life insurance to save their businesses.
Absolutely.
I forgot who the guy is from J.C. Penney, but he, same thing, used the cash value of his policy to save his business.
Don't get me started on J.C. Penney, Deb. I actually miss J.C. Penney though. Really great.
I know the malls are just becoming a deserted
Obsolete.
like building.
We like
Yeah.
again, online shopping was too good to be true. Now it's just the next big thing. You don't even go into the mall. So
Yeah,
it's the same
especially at
thing with
Christmas.
this. Yeah. So what are
Yeah.
some common misconceptions that people think about the IUL that need to be addressed there?
That it's a scam.
Yeah. Wait,
Some
I can
people will
bank
say that
myself?
it's a
I'm the bank? Yes.
yeah. People, yeah, I know people think it's a scam, but it's not. There's literally 3 different IRS codes that make up the permanent life insurance that allows you to do this. And I mean, if there's IRS codes around it, it's not a scam.
Not a scam.
Um, also the misconception is, and you'll hear a lot of people say, well, the cost of insurance gets more as you get older. So it's going to eat into the policy. It's going to make the policy lapse, blah, blah, blah. Not if it's structured properly. And I've shown people this, if it's structured properly, you're making so much interest by the time you're getting into your 60s, 70s, and 80s that it's a mere pittance to the cost of your insurance. And if it's structured properly, your cost of insurance is minimal because the cash value has gotten pretty close to your death benefit amount. And you're only paying for the amount of insurance that's between your cash value and your death benefit amount. So if your death benefit amount is 500,000 and your cash value, for example, is 400,000, you're really only paying for $100,000 of life insurance. So if you're paying for $100,000 of life insurance at 70, that's far cheaper than paying for the $500,000 if you don't have any cash value.
It's just like the
So
staircase you talked about. They're going to drop you. Then you got to reapply for life insurance. And then you're going to pay more and more as you get older. And it's not there anymore. So,
yeah.
Deb, I got to brag on you a little bit because you told me to put my IUL into a trust and, leverage that trust to make decisions for my, policy. And you showed me those numbers and you're like, look, you're going to put in, a good amount in the beginning, but that is your choice. But if you
Hmm.
do that, look at the upside. So anyone
Right.
that's a business owner, an investor, or just understands numbers and the projections of what's going to happen, it is a no-brainer. That's all I have to say.
It is once you understand it. I mean,
Once
a
you
lot of
understand.
people, you have to take the time to, I mean, when you and I went through it, I mean, I think we spent at least an hour when I went through that presentation with you and stuff, because I want people to really understand what you're getting into, how it works, the flexibility of it, and you know the pros and the cons. And there are some cons. There's fees and expenses, and there's a cost of insurance because you are buying a product. But to me, I kind of think of it as like almost like a CD, except it doesn't have the restrictions of a CD. It's like a big savings account, right? You just dump your money in there, use it when you want to, for whatever you want, without having to get permission from the bank because you don't have to go apply for a loan. You don't need a W-2 or tax returns. It's your money. So just dump it in there. It's safe from the market. It's not going to, lose money because it's not directly invested in the market. So you could only go up, right?
Yeah.
So
And I told
I
you
just
that, Deb. It's important. I was like, okay, so if I don't have an investment to invest in, I'm going to invest my money back into my policy because it's acquiring interest every single day,
right.
whether I have any new money in there or not. So I know a lot of people are going to want to know, how can I get started? Like, what amount of money would they need to, get their first policy, and how soon could they borrow money out of their policy?
Well, I mean, to get started, give me a call because I
Tell
want
them
to
why.
I want to completely explain, and show some examples of like how it could be used and all that. But typically, the guideline we use, and it's not a rule, but it's a guideline, is like however old you are, like add $100. So if you're 30 years old, you should be putting 300 a month into a policy. If you're 50, 500 a month into a policy. So that's a guideline.
Wow.
If you can put in more, obviously that's advantageous because the more you put in, the faster the cash value will grow, and the more cash value in there, the more compound interest accumulates. So but I mean, you have to have the ability to overfund it, right? That's the whole point. You can't just pay the bare minimum premium because now you don't really have anything extra going into the cash value. So
Mhm.
you really have to be able to overfund the policy, and you have to be disciplined. I mean, it's not for people who think it's a get rich quick scheme, because it's not. It's just another tool in the tool belt of how to save money and pay less taxes and create generational wealth. It's not a get rich quick scheme at all. But if you're disciplined and you put that money in over, several decades, I mean, the amount that it grows to, and then the fact that you can still use it tax free, with no loan documentation, it's just a win-win in my opinion. I mean,
It's a no-brainer.
I think so. Yeah, I really do. But
I loved it, Deb.
I just want everybody to know about it, because I didn't know until a couple of years ago. And you can really change your future if you
Your life,
plan correctly. You know what
your
I mean?
family's life.
If you have the information to make informed decisions, and then decide like which one of these avenues do I want to go down, and maybe you want to put a little bit into each avenue depending on what your goals are. But the fact that so you asked me, why would you use a life insurance policy over a 401k? One reason is because once you go to take that money out, so when you're retirement age, 67, whatever you are, you start taking the money out to supplement your retirement. Well, the cash value, the account value rather, I'm sorry, doesn't reflect the fact that you're taking out these loans. So for example, if you have $500,000 of cash value by the time you're 67, 68, you start taking out loans to supplement your retirement, tax-free loans, you don't have to pay them back. Well, the entire $500,000 stays in your account and continues to accumulate compound interest, even though you're taking out money every year to supplement your retirement. And people will say, well, how is that possible?
I couldn't wrap my mind around it.
I couldn't either. I was
made
like,
you explain it like 5 times, but with the 401k, the money does go down when you pull it out, and you pay taxes when you pull it out prematurely.
Right. So that's a lose-lose. It's a double negative, right?
Yes.
If you take the money out of your policy through a loan, the full $500,000, like my example, stays in your account and continues to compound interest, because you're really borrowing money from the insurance company. You're not borrowing your own money.
My mind was blown.
So there's two different types of loans, usually sometimes 3, depending on the carrier. But the loan that you want to use is called the variable index loan, because that's the one where your money stays in that indexed account growing regardless of the fact that you have outstanding loans. So that right there makes your retirement money last twice as long, because I have done multiple illustrations, and that's what I have found, is that your money lasts twice as long because the original amount is growing. It's not going down.
So much,
it's not going down from your loan. It's actually growing from the interest it's accumulating, and you're taking out loans and it's still growing. So it lasts twice as long as your retirement account will.
I had to do it for myself, Deb, and I did. And I pulled out my money within like the first week that I had my policy, and it's still growing.
Yeah. Yes. So to answer your question, when can you pull out the money? As long as you have cash value, you can pull out the money. You can't pull out the whole thing because you have to leave some in there for, expenses and whatnot. But regardless, another one of the myths of that people talk about with IULs is that they're expensive. There's a lot of fees. There's fees and expenses, yes, because you're buying a product, right? You're getting life insurance, but they go down over time. The first 10 years have the most fees and expenses, and then it goes down significantly. Your 401k, your fees are the same. For as long as you have your account, whether you're making money or not, your fees are the same. So either you're going to pay the fees and expenses of a life insurance policy, or you're going to pay the taxes and the fees from your 401k. So, I mean, at least you're actually getting life insurance and living benefits and all this other stuff with the policy versus your 401k. So that's why I like to say diversification is kind of key. I wouldn't say do one over another, but diversification, I think, is definitely something that we should strive for when we're talking about wealth. And like what you're doing. You've got some real estate, you've got your policy, you've probably got other stuff. So
and it depends on where that person is in life, who they are, what they already have. to depend on like how much they want to start with, how much they want to put in every year. And I thought you did a really great job of explaining that to me. And what we came up with together made the most sense for what I wanted to do in the future. Because like you said, it's not an overnight thing. It's something that you're going to build up to and something that you're going to grow over time and leave to people once you're gone. So really important.
Right. Yeah. And when you mentioned the trust, well, I think you said you wanted generational wealth and you wanted a family compound. So
Yes.
when you told me that, I was like, well, you better set up a trust because, I don't know how the family compound's going to go if something happens to you. But
right. And who's going to pay the taxes? You know what I mean? You're like, no, the taxes are always paid first before you give anybody any money. There's so much flexibility with the trust. And then on top of that, if I want to grow my policy further, I love that that was an option.
Right. You can put additional money in there if you want, up to a certain amount, and that's what we do is we plan, like, how much do you think you're going to want to put into this policy? Because there is a max based on what you tell me, there is a max where you don't want to create what's called a modified endowment contract. So you can overfund your policy and then you can actually add additional money into it to a certain point. But then after that, you have to wait till next year.
Yes. And I think it's
important.
And
if you're in that position where you have to wait till next year, good for you.
Good for you, right? I hope that's me. But Deb, I think it's good for people to know it's custom to you. It's not like a one size fits all. You have to talk to the right person that's going to do a consultation and understand what you're looking to do.
Right. And you have to make sure it's structured properly. So if you, meet with an agent and you tell them that you want a policy for cash accumulation, infinite banking, whatever you want to call it, be your own bank, it's structured differently. So when you do an infinite banking policy, we do the complete opposite of what a traditional life insurance policy is bought for, because most people buy life insurance for the death benefit, right? To make sure they cover their loved ones if something happens to them. So there's typically a pretty high death benefit because, let's face it, mortgages are expensive. Living today is expensive. So typically there's a high death benefit. So the premium is higher because the insurance company's going to have to pay out quite a bit of money when you pass. Well, when we do infinite banking policies, we do not structure the policy for a death benefit amount. I mean, obviously there is one, but that's not the primary goal when you're talking about a life insurance policy for cash accumulation. So when we're doing a cash accumulation policy, we want the least amount of death benefit. Why? Because we want our cost of insurance to be as low as possible so that more of the premium amount goes into the cash value and less of it goes to the cost of your insurance. So based on how much you're going to contribute, your age and gender and all that determines what that initial death benefit amount is going to be. But we don't want it to be high. We want it to be low so that your cost of insurance is low. So if you're putting $500 a month in, hopefully your cost of insurance is, under $100 a month, and most of it's going into the cash value. So it's the complete opposite of a regular life insurance policy.
And I don't want to get too far into the weeds there, but I think this question is super important because what can people use that money for that they pulled out from their policy that will actually help them grow their own money and their policy even more? Give us an example.
Anything. They can use it for anything they want. That's my point. Like if you went to the bank and wanted a loan, they're going to want to know, what are you going to do with this money? Well, the life insurance company is there. It's your money. Take it out and do whatever you want with it. There's no penalties. You don't have to be a certain age. It doesn't have to be in there a certain amount of time. There's, like I said, no required minimum distributions. It's not taxable if you do it properly. But your policy has to be structured properly too. So if you want a cash accumulation policy and an agent gives you an illustration and you have zero cash value in year one, that's not structured for cash accumulation, right? So,
but I'm thinking even the other side, Deb, of private money lending. I have a set interest rate on my money that when I pull it out, and if I lend that money to someone privately for 20% instead of the 5% annual rate that I have, I've made 15% interest, made more money to put back into my policy that's going to also continue growing over time. It's like a triple. It's like I made triple the money I would have made.
Right. With your policy right now, your loan is 4.64%. So if you took, I don't know, let's say you had 50 grand that you took out of the policy. So you're going to have a 4.64%
I
rate. That's
love how you know
annual.
my interest
And you
rate.
go, I'm on
People
top
don't
of
hear
what all
those
my
interest
clients
rates.
are doing. I get
People don't
notified when
hear
you
them
take out a loan.
People are at 7% interest right now for mortgages, and I got a 4.64% policy.
Well, you got a 4.64% loan interest rate on your policy. But yeah, so yes, if you go loan that money out at 15, 20%, you're making arbitrage, right?
Yes.
Plus if you're making money in the index, that's compounding too. So if you make more than 4.64% in the index, you're making
Woo.
money there as well. Plus you're making money as a private money lender, or if you took the money out to, to buy a long-term rental, and you could pay the loan back using your rental income from that property. I mean, typically we tell our clients, like, if you're going to take a loan out, do it to a cash generating activity so
Yes.
you can pay the loan back, at least, in the early years of the policy.
Mhm.
So you don't want to take out a loan in the early years and leave it out there accumulating loan interest, because that's just going to take a wash of the interest you're making in the policy. So
Yes.
you want to at least pay the interest. If you can't pay the loan back, pay the interest, which is,
Yes.
pretty cheap at 4.64%. But if you pay your loan back in 6 months, it's half of 4.64%.
Right.
So,
Exactly.
you
That's
know,
annual. I thought that was really important. And I want to give people some context. Like, I had some money and I was like, you know what? I'm just going to go buy a new car and put cash down. And that was so dumb. I was like, wait a minute. I'm going to put cash into a depreciating asset, which means as soon as I lay this cash down, I've lost some of the money I just put down. And
yep,
then I talked with you and I was like, I'm going to put this into a policy and I can borrow from my policy and buy a car with a lower interest rate if I want to. But I didn't even end up doing that. But it really puts things into perspective, like, what order are you doing things? And does it make sense when you
right.
look at, is the money working for you?
Right, and that's what you want to do, hopefully, if you take a loan, is put the money to work for you and not into a depreciating asset. But you can. I mean, if you can afford to pay the policy back and you would rather not go through all the paperwork at the dealership and just use your own policy, or have to worry about qualifying for that,
Right.
because let's say real estate investors, we try to overinflate our expenses.
Damn,
So
I don't
sometimes
know about that.
our income doesn't allow us to qualify for loans, because we do have a lot of expenses.
You do.
So by using a policy loan out of your life insurance policy, you don't have to qualify for anything. You just take the money out because it's yours. So you don't have to go through any of that stuff that, typically a lot of real estate investors can't qualify for loans, because we don't make a lot of money.
I love it. Air quotes.
I mean, so yeah, I mean, there's just a lot of advantages. So like I said, I think diversification is key, and I just feel like everybody should at least be aware of the fact that this is out there, and it's like,
It's real.
something that you can
Not a scam.
participate in. Yeah, it's not a scam. Walt Disney, and the guy from J.C. Penney and J.D. Rockefeller, all those people, I don't think they would have gotten
No.
involved in scams.
And it
So
wouldn't be in the tax code.
no.
So Deb, who is the typical person that this would be great for? I know it's great for everyone, but who would you say right now, if you're this person, you need to go get you a policy?
Um, like a no-brainer one would be someone who has maxed out their 401k at work. Like, so they make a halfway decent income, so they've maxed out their 401k, and they've put as much as they can into their Roth, and now they don't have anywhere else to put the rest of their money except in
Mhm.
a savings account or in the market. I would put some of that money into a life insurance policy and let the cash value grow and not be exposed to the market. So, I mean, dump as much as you can into your 401k and your Roth, but whatever extra money you have left, put into something a little safer,
Yeah.
that doesn't have restrictions, and you can access that money and it's liquid when you need it. Because you can get a policy loan. How long did it take you to get your money when you applied for the loan?
Like
Oh,
3 days. First of
Yeah.
all, I applied wrong once because I missed a box. So that was on me. But it's super secure. And they were like, you got to fax this because that's the only way they know that it's not fraud, which I actually really appreciated. So I just went
Yeah.
to the UPS store, faxed it over. And the day that I did it, they sent it the check in 2 days.
Yeah. Yeah. I don't think you'd get a loan that quickly from a
No.
bank, but I mean, your loan rate being under 5%. I mean, my credit cards, and I have a good credit score, but my cards are 17 and 18%. I mean,
Right.
that's just standard now for whatever
Yes.
reason.
And we don't even
Um,
question it. We don't even question
I
it,
know.
you know?
Yep. But that's a lot, if you
Yes,
could,
it is.
use a policy loan to pay off your cards if you could, and then, instead of making all those payments to different cards at those high rates, just take out a policy loan and make the payment back to your policy.
That's
It's,
smart. I didn't even think of that. So,
yeah.
Deb, who ideally would this not be a great fit for? Because, of course, like we said, there are pros and cons with everything. Who would this may have some trouble trying to get a policy?
Um, People that have health conditions.
Yeah,
So if you've had cancer or like something major, organ transplants, things of that nature, you're probably not going to qualify. However, some people use their children to set up these infinite banking
love
policies because they have health conditions that either would make the cost of insurance too high, so that that cash value is not going to build up fast enough, or they just are uninsurable, so they can use their kids' health if they're an adult, um, and use a policy. It's called a
it.
surrogate insured. So
I
you're
love
still the owner of the policy. So that person that can't get the insurance or would be too expensive is the owner of the policy, but the insured is their adult child.
that. Sounds
And
like a win-win.
yeah, and so the owner also decides who the beneficiary is. The owner pays the premiums, and the owner also has access to the cash value. The insured has like nothing to do with the policy, except obviously if that person passes, then
Mhm.
the death benefit would come into play. But other people that it is not for is people that just don't have the additional funds to overfund the policy, and also people that aren't disciplined enough to be consistent and fund it the way that you told me you wanted to fund it, because I'm going to set it up based on what you tell me. So
Mhm.
we want your money to be working for you as efficiently as possible, but you have a role in that as well. It's not just
Absolutely.
the policy and what the index is doing. The
It's a
client
big
has a role in that as well.
responsibility. Absolutely.
It is.
It's something that you're committing to. It's a commitment. And
Yeah,
if you see the long-term goal, it's a really, really good and smart commitment to make. So I'm glad
it
that you
really.
explained that. You explained that really well to me. You're like, look, this is what you're getting into. And if anything happens, there are insurances where you can do, very, very small amounts so your policy won't lapse. So you are
Yeah.
protected there. So that was important. But for someone, say, that has an existing policy that's not an IUL, Deb, are they able to convert that into an IUL?
Yes, if you have a permanent policy with another carrier that's just a regular life insurance policy, and you want to convert it into an infinite banking policy, or you can convert it into just another regular permanent policy as well, but that's called the 1035 exchange. So basically, you're taking one policy and the cash value that's built up there and switching it out for another one. So you're not going to pay any taxes on any of the gains in the cash value of that policy by doing a 1035 exchange. Whereas if you just, canceled it and put the money into the other one, you'd have to pay the taxes. So we do a 1035 exchange, which is similar to a 1031 exchange in real estate.
For
So
my real estate
you avoid
folks,
the
I
you
know they
avoid
like
the
that
avoid the
sounds
taxes, and yeah, you just take the cash value out of that policy and put it into this new policy
so
and
that's
stop
great,
funding
Deb.
that one. Yeah,
It's always a workaround. There's always a way to do it, a way to say yes instead of saying no. So I really like that you
right.
shared that with us. So what
Yeah.
factors determine kind of the cost of the policy and what people need to kind of think about and look out for?
Health is a big one.
Mhm.
Age and health.
Okay,
So if you smoke, you are going to pay much higher rates,
gotcha.
like much higher rates.
Makes sense.
So your health, your age, your gender to some degree, for whatever reason, men will pay, a 25-year-old male will pay more than a 25-year-old female. similar
They're
car
risky.
insurance.
We know why.
Exactly. That because they make bad choices.
Sorry, guys. We're joking. We're joking.
Just kidding. I'm not. But no, seriously, that's why. I mean, I think that's why the insurance carriers, like
Oh my
a
God.
male car insurance driver, is going to pay more than the female, even
Every
at the same
time.
age in the same car,
If they
because
get a
they,
red car, it's going up. It's
yeah.
like you're a
I
big
mean,
risk.
so yes, so gender, your health, big time, and if you smoke, this definitely has a big factor, and your age. So, but like I said, if your health is going to make your rates too high, or if your health makes you uninsurable, you can use a surrogate policy on. It doesn't have to be your child, but it has to be someone that you have what's called an insurable interest in. So it can't be a stranger, for
Right.
example,
People
because
just
you have
filling
to
out
be able to
policies all over.
explain, like, why would you want insurance on this person if
Right.
it's your second uncle removed from your whatever.
You be side-eyeing them like, are you planning to go kill somebody or something? Like, what's going on? Like, that's crazy.
Yeah, so you have to have an insurable interest, but that is a way to, still be able to set up an infinite banking policy, even if you have health conditions. You can use somebody else's health. People do it all the time.
That's really good.
Um, a lot of people ask me if they can just get an infinite banking policy on their child, and the answer to that is yes, and you will need your own insurance because some of the insurance carriers have caught on to people doing just that, right? Because the cost of insurance is real
It's so
cheap on a
much.
5-year-old
Right.
who's very healthy, clearly doesn't smoke, and
And,
the
and
insurance is
meanwhile, the
probably
mom and
$1 a
dad are
month.
like out back smoking cigarettes. You're like,
But the thing is that the insurance companies realized that parents were starting to do that. And honestly, it doesn't make sense, right? If you as a parent don't have any insurance and now you're
right,
going to take out an infinite banking policy on your child. I mean, if I was the insurance carrier, I'd be scratching my head as well. Like,
right,
well, what is this child going to do if something happens to you?
right, right.
Right. So now the insurance carriers they want the parents to have 2 times the amount of coverage as the child if it's a juvenile. So if you're
Okay.
under 18. But
That's
if you're
great.
over 18, that rule is not in play. But if you're going to try to get a policy on a minor and you're the parent, you have to have 2 times the coverage that they have.
That makes sense. I love that rule being in place because it
It does
protects
make sense. Yeah.
it
Well, there's
makes
no sense in your kid having a policy and you don't have one. Like, you need
and
to
then it's
protect
gonna
them
last
first.
because you won't be able to pay it, if they're 5 or 6 years old. So
Right. Yeah,
Deb, can
exactly.
you share with us? We're gonna, wrap it up shortly, but can you share with us an empowering story or someone that you helped use this, that really made a difference with where they are today?
I'm trying to think of who and then how to change their identity.
Right. Okay. Confidentiality. You know what, Deb? I'm not gonna put you in the spot.
I can't,
Tell me why
well, I
you're
mean, it
passionate.
would be really vague.
Tell me about why you're passionate about what you do and helping people use this strategy.
I'm passionate about it because when I learned about it, I realized I could be so much further ahead than where I am today because
Ooh,
I would have had another avenue of where
yes.
I could have placed my money, but I didn't know about that other avenue until a couple of years ago. So, um, I just I want everybody to have at least the opportunity to know about this as an option for where to put your money, and if you want something that's more safer than the market, but also
Yes.
has a lot of advantages. So my passion is to just like help people be financially savvy, financially free, and because like we've said, this stuff's not taught in school. So who's going to teach it to you, right? It's
Right.
maybe your parents, but your parents didn't get it in school either. So if they haven't learned all these things, then you have to go figure out who to learn it from yourself, but you don't
Yes.
know what you don't know, right? You
Yes.
can't ask questions about something you didn't know existed. So I want everybody to know that this is an option for you. And if it, fits in your toolbox, then you might want to look into it because
Mhm.
there are significant advantages. And like I said, the money lasts twice as long as your IRA will because the money stays in the account compounding even though you're taking it out. So it has a lot of benefits, but
Wow.
it's part of a diversified strategy, I think.
Yeah. And I was kind of bummed that I didn't know about it sooner, and
You're 28.
right. Deb,
Well,
please
probably sooner,
with
you probably
everybody.
wouldn't have been able to overfund it though, because I
I'm
mean,
28.
you have to have the income to overfund it. So now that
Yeah,
you're a rock
you're right.
star,
Right. So everything happens in timing. So anyone that's feeling like,
yes,
oh my gosh, I'm not in a position to get it, now that you know about it, you can help yourself be in the position to get it when the time is right. So that's very
exactly.
important, Deb. So
Exactly.
what
Timing
piece
is
of it?
everything. I mean, it
Yes.
might not be something that you can do right now, you meaning the audience,
Yeah.
but at least be aware that it's available. You know what
You
I
can
mean?
work
Like
your
that's
way up.
all yeah, I just want to educate people on like, y- don't do what the herd does. Like, blaze your own trail, go do something different, and you'll
Do
probably have more of
research.
an impact on yourself because
Mhm.
when 401ks came out, you probably don't realize this because you're too young. Well, you are too young, but in the early 80s, when you weren't born yet, is when 401ks came out. But back then, income tax rates were very high. So
Mhm.
it made sense to put your money into the 401k and get that income tax break back then in the 80s because income tax rates were high, um, mortgage rates were high. So everybody was trying to save money on taxes. But today, we're in some of the lowest income tax rates we've ever had. So I don't know that when we retire, we're going to get any lower than where we are. You know, some people say when you're retired, you know, you'll be in a lower tax bracket, so save all that money. But that might have been true in the 80s, but we're already in that lower tax bracket now. So in another 10 years or 20 years when you're going to retire, I don't know that we're going to be in any lower of a tax bracket. So, you know, the 401ks made a lot of sense back in the early 80s, but not as much sense right now because we're not in the same environment.
Right. And that makes total sense. And Deb, I want to close it out for our viewers with this. If what would you tell your younger self? What piece of financial advice would you give your younger self?
Pay yourself first.
Pay yourself first. That's a mic drop. I love
I got a pen.
yourself. There we go. Pin drop. Pay yourself first.
No,
How
but
often are we not
seriously, I
doing that?
mean, I know, because let's face it, I mean, when you're young and you have extra money, right? You go to shopping, you go on vacation, buy all this stuff, which is great. I'm not suggesting you live like a pauper, but like establish a goal of a savings of X per month or per year, and you know, break it down that falls into X per week, and save it, and then go do your shopping and your traveling and whatever. You know, don't do it the other way around. Well,
Don't
what do
do
I
it
have left to
backwards.
save?
Like you're taught so often. We do all of the things in the wrong order. Get that savings and then you can do all the other stuff anyway. So that's great advice.
Exactly. Yeah. I mean, like there really should be financial education in school. I
Should.
don't understand why there is not, but
Tax education, all of that stuff. And you just are left, especially as a business owner, to figure it out as you are building that business. If we're not taking financial literacy classes outside of, our busy schedules.
right.
So Deb, thank you
I'm
so much.
sure even as a business owner, there's things that you wouldn't know, right?
I'm
Because if you
still
don't teach
learning.
financial education in school, they're certainly not going to teach anything about how to run a business. But
It is so hard.
there's probably all kinds of ways to save on taxes, and you know that you don't know about either until you're in the weeds and you have to figure it out.
In IUL, commercial real estate, that I had to
Hmm.
find out after already, doing 1,000 other things. So you're right,
Yeah.
100%. Deb,
Yeah.
where can everybody find you at? First of all, you guys, you won't have to look too far because I'm going to put Deb's calendar link in this video description. But outside of that, Deb, how can people connect with you? How can they get information? Please share with us.
You can find me on Facebook or Instagram. My Instagram is right there at dsteph944. I'm also on Facebook and TikTok, all the social media, YouTube. My channel is To Your Financial Health. So, but I will definitely give you my calendar link, and you guys, my phone number is 401-575-1122. Feel free to call me and be happy to schedule an appointment and answer all and any questions you have and show you illustrations if you'd like.
She really does. Deb, you go above and beyond. And again, the gratitude I have for you being here is just so amazing because I know how many people need to hear this information. So thank you so much. And
well, thank you for having this platform to get the information out there, because it's needed. I mean, we need to stick together and educate one another,
stick together, grow together, make more money together, pay ourselves
Yep.
first together.
Yeah, exactly.
Well,
Create generational wealth together.
together. Yes.
Yep.
Thank you so much, Deb.
Thank you,
Also,
Dale.
guys, I want to thank you as viewers for joining us today and being here to hear this special segment by Deb Stephenson. She is absolutely phenomenal. So if you're thinking about getting a policy, make sure you reach out to her. Again, I appreciate every single person that joins these YouTubes, and I hope you receive tremendous value today. See you next time. Peace.
Thank you.